Welcome back. Today, we're going to answer the question, what is a bond? My name is Adam Lisowski. Welcome to the 3-Minute Advisor. Let's start the clock. When it comes to investing, I think most people are familiar with the term bond, but often that's where the understanding ends. While I can't make you an expert on bonds in the next 3 minutes, hopefully I can help illustrate a little bit about how bonds work, why they're important. Let's get started. A popular misconception is confusing bonds with the government savings bond program, which was popular in the 70s and 80s. But when we talk about bonds that are used to diversify a portfolio, for instance, what we're referring to is an investment that's being issued as a debt by a company or a government. If you're a bond investor, it might be helpful to think of them as reverse loans. They're asking you to borrow your money, and in exchange for holding that money for a certain amount of time, they're going to pay you interest along the way. Let's say that you buy a $1,000 bond from company ABC. Now the company takes your $1,000 and holds it for a certain amount of time. And at the end of that certain amount of time, they give you your $1,000 back. While they're holding your money, they're going to pay you an interest rate, commonly called a coupon. It's usually paid twice per year. Now historically, bond values can be fairly predictable. You know the amount of annual income that you're going to get while they're holding it, and you know when you get your $1,000 back. Like with many things in investing, it comes back to diversification. If you hold your entire retirement savings in the stock market and something negative happens to that market, your entire portfolio could be at risk. Bonds, however, are traded on the bond market, and a negative impact to the stock market might not have that same degree of impact with bonds. In addition, bonds can sometimes be secured by assets, meaning that if a company were to go bankrupt, they're still obligated to pay back bondholders their principal and interest. That is a benefit that shareholders of stock don't always have. For investors who are in target date fund or balanced mutual funds, there's a good chance you already have bond exposure, but it's worth a double check. If you're in stock ETFs and stock funds, there's a good chance that your bond exposure is lacking or might not even be there at all. Now you can go about building a complicated bond ladder portfolio, but for most investors, they invest the same way they do with stock when it comes to bonds: bond mutual funds and bond ETFs. Now keeping that balance of stocks versus bond in your portfolio is extremely important. Too many bonds in your portfolio might underperform over a long period of time. Too much stock and not enough bonds, you could be carrying far more risk than necessary. As always, you can do this. If you can't, reach out and let us know. Maybe we can help. Thanks for watching.